Looking at the Markets with David Modell.
Welcome to Looking at the Markets with David Modell. Our guest today, and our frequent guest here on Looking at the Markets, is Mr. Seth Golden. He is an expert in a number of areas in finance, including, yes, VIX product trading, but also retail. He loves to trade retail and invest in retail products, such as Fitbit, such as Under Armour, and others. And so we're going to be focusing on the retail sector and those types of products today. So, Mr. Seth Golden, welcome back to Looking at the Markets.
Pleasure to be back, David. Always appreciate being able to disseminate some information on, some of these lesser followed companies.
Well, we're going to try to change that because I know that you've been quite profitable with these products, including Fitbit, Under Armour, these kinds of things. So first of all, people need to check out Seth Golden on talkmarkets.com. He's a frequent contributor of articles there. Seekingalpha.com. Check out his articles there. I also want you to check him out on Twitter at SethCL, on StockTwits at Seth Marcus. And all that information is going to be on the screen and in the description. And also we're going to talk about phenomgroup.com. You're going to want to check that out for the free resources and for other resources. We'll talk more about that. All right, so let's talk about Fitbit. Now, Seth, before we jump into Fitbit's third quarter results, there was also some news out of Under Armour recently regarding their wearable product. It's called Healthbox. Can you tell us more about that?
Disaster.
Uh-oh.
To put it plainly, I remember I think it was 2 years ago at the CES. I go to the shows and the conferences around the nation to see the new products and talk to management teams and test out the products and whatnot. And I believe it was the 2015 Consumer Electronics Show that I first saw the Healthbox, the Fitbit Blaze, and a few other wearable type products. And I remember specifically when I was testing the Blaze, the Healthbox, and then I heard the price point. And I thought to myself, rather sarcastically, in what world? So, when I got back to the office after the CES show, I, went into a little bit more, did some in-depth research and due diligence on Under Armour's venture into the wearable space and connected health. And I discovered how much money they had spent over maybe a 3-year period in connected health and wearables. They had spent over $700 million. And this was what they came up with, the Healthbox, which bundled together was almost $400, whether you got it at Best Buy, Dick's Sporting Goods, Amazon, a few other retailers. But that was a big problem also, is the distribution channel just wasn't there for Under Armour's Healthbox like it is for Fitbit or Apple Watch. And so I wrote this article, analyzing Under Armour, their wearable products, Fitbit's wearable products, Garmin, etc. And I conclusively, in rather, predictory fashion, said that there's probably no way that Under Armour would ever be able to recoup their investment of $700 million from this product. And every single year, if you go and you look into their income statements and their balance, their financial, their 10K, they've taken a loss every year from that product segment. And in the last quarter, they took their biggest loss and impairment charges. And basically what that tells me is they're just getting out of the business altogether. So for all intents and purposes, I think we've seen the last of the Healthbox. It's unfortunate, but it's one of those, feather in my cap there, or, pat myself on the back. I did predict that this would happen. It was just the wrong price point, lack of distribution. They didn't really have their brand, couldn't quite make that jump into the wearables segment, especially with just one product. You kind of need a collection, and that's what Apple's been doing. Apple Watch 1, 2, 3, and the Nike Special Edition. Fitbit with, they've got 10 products out there in the wearable space. You can't just expect to sell one and have that take off in the market. And forget about profitability, just the sales weren't there either. So sad state of affairs, but that's, it also shows, other companies' dominance, like Fitbit. People were writing articles last year saying that, Under Armour is going to, because of their big brand in clothing and apparel, and Steph Curry and all of their, endorsements, that they're going to kill Fitbit. And it wasn't even close. It goes to show you how much hyperbole there is, and so I positioned that article last year in January 2016, trying to, level set the playing field so that investors fully understand and appreciate the potential of that product for Under Armour. I was extremely bearish, and, it is what it is.
Yeah, that article will be in the link, a link in the description of this video. I assume you're referring to the one called Under Armour, Fitbit, and the Wearable Market, Potential Under Deeper Analysis. I remember in that article, it's like you saw all of this coming. So not to toot your own horn, but you did. You called it. So there you go. So people, if they want to read more of that article, check out the link in the description below. Let's dive into Fitbit a little deeper.
Okay.
I remember in a recent video you mentioned there are a lot of things that Fitbit had accomplished through their second quarter that gave you some more confidence that the company was indeed on the right track. Can you just review those factors again?
Yeah. This is a transition year for Fitbit. They were, the beginning of the year, the first half of the year, trying to work off excess inventory in the sales channel. They had their retailers, their distributors around the world just had bloated inventories. When you have bloated inventories, Fitbit has to issue, credits and work with their retail partners, so far as discounting goods so that the retailers can sell through the product faster. So that was the first, half of the year. And that's why the stock price suffered, because the sales, during that period where the retailers are just trying to push product out of the door, well, they're not backfilling it, they're not ordering product, just to have, backup. So Fitbit sales decline. So that was the first step to kind of the bottoming phase for Fitbit. And, when they reported in Q2, that was going to be the first time that Fitbit could say whether or not these efforts were, proving themselves out, meaning that, they were able to push the product through the sales channel. And they did. On the Q2 call, management said that the sell-in and sell-out were now balanced, and that their inventory channels were clean. And that's such a huge thing. And why is it so huge for a consumer product company like Fitbit? Well, it gives you pricing power. So, once you have clear inventory channels, clear sales channels, it means that you can sell product back into these retailers at the usual wholesale price. And you're not having to discount continuously and giving manufacturers rebates and things like that. So now you have pricing power. That was a key indicator in that Q2 report, is they were actually able to increase their average selling price. The only reason you're able to increase your average selling price is because you have clean inventory channels. So those were two of the really big indicators that said to me, Fitbit is on the right track and they should be able to accomplish their goals in 2017. So the third aspect in that Q2 report was gross margins. During this stage of the business cycle for Fitbit, you don't really, if you want to get a clear, understanding of where they are and where they're heading, we know where they were. We want to know where they're going. So far as gross margins, you don't really want to look at year over year at this point. You want to look quarter to quarter to see if they're improving finally. And in Q2, they did improve sequentially. From Q1 to Q2, the gross profit margins improved. And that again, so those are three factors: clean sales channels, the inventory in the sales channel, the ASP, average selling price, increased sequentially and year over year, and gross profit margins are increasing sequentially. Three factors, perfectly, I've got my stool and I'm good to go. Now I just wanted reassurance for Q3.
And that leads us to the next question. Great, we had these improvements, those three main improvements that you listed in the second quarter. But what about the third quarter? Do you think those, can we continue to see those types of improvements?
Right, so, they just reported a few days ago, to kind of give you the broad strokes and what they reported. They beat on the top and bottom line. They had a 1 cent loss. They did $393 million rounded, which also beat estimates by like 1.2, 1.3 million. So they beat on top and bottom line. Again, gross margins improved sequentially. They were still down year over year, which is expected, but they improved sequentially. The ASP went up again year over year and sequentially to $105, which is outstanding. When they were growing, when they were actually, in full growth mode on revenues and earnings, the ASP was only about $100 to $101. They're at $105 now. They introduced new products, the Fitbit Ionic smartwatch, the Fitbit Flyers, and some of the accessories to go along with that, as well as the Alta HR product. All launched pretty much with limited, it was a limited launch. They didn't go into full scale, distribution, but it was the smart thing to do. So there was a lot of success stories to be told from that Q3 report, all of which I found favorable. Now, it could have been even better. When you dig into the numbers and when you actually read through the transcript of the Q3 report, you come to find that their biggest distributor in the United States is Winit, WYNIT. That's their biggest distributor in the United States. Well, the distributor declared bankruptcy in the third quarter. They had sold into the distributor about $8 million worth of product. So guess what happens when the distributor goes bankrupt? Well, you don't get to record those revenues. So imagine if they actually did have, the ability to record those revenues, not take the impairment charge on it and, create bad debt, because that's what it's going to equal out to be. It's bad debt. They would have beaten revenue as the average analyst estimate on revenues by $10 million. I mean, it really was a very good quarter that kind of got marred by this, this element of, that was out of their control. But at the same time, investors in a consumer product company such as Fitbit, or ones that frequent these type of companies, they take this very seriously. When you lose a major distributor, it's a problem. Now you've got to, find another, distributor that has the appropriate credit rating, that is willing to, market the product for you in their region, United States, and probably, Canada. So it is a big deal, and it stinks that you don't get to record those revenues. But it also is concerning as an investor. You've got to go out and replace that distributor with somebody of reputation and has the right credit rating and is going to abide by all your distribution terms. So most of these distributor deals, partnerships, they can be anywhere from 3 to 5 years. The other aspect is generally, when these products saturate a market, it becomes really difficult for a distributor to make money thereafter, especially if it's not an essential good. Fitbit, nobody needs a Fitbit, so it's not like you have to buy another one it's not an iPhone. You don't have to buy a new one every time a new one comes out. So it becomes a difficult business for the distributor. And what winds up happening over years is the vendor, Fitbit, has to buy the rights back from the distributor for that region. I've seen this many a times with SodaStream in years gone past, where they had to buy their South Korean market back from the distributor there. They had to buy the Japanese market back from the distributor there because, well, once it got saturated, the business became too tough and the distributor no longer wants to really be in that business. So they're not spending money to market your product, and they're not pushing it out to their retailers either. So it was tough. But all in all, it was a very clean quarter. Sales were good. Earnings were better than expected. They tightened guidance, which was good. They tightened, both the bottom and the top end of guidance. It's possible that they could show a surprise that they would have shown this quarter in the next quarter. So.
Yeah, sure. Now let's talk about the price action of Fitbit, if you don't mind. I remember since we last spoke about Fitbit, the price went up to $7 a share,
right?
And then suddenly back to $6 a share, shedding $1 there, which is a lot for a stock at this particular price point. So what do you think happened there going into quarter 3 earnings?
There was a note out from Cleveland Research at about, $6.80, $6.90. Fitbit was trading at the time that this note from Cleveland Research came out. And Cleveland Research, for those that aren't familiar, they're really sneaky. I'm not going to say, I don't know. I don't know that they're, paid to put out these notes in the market or whatnot. But what I can say is, when they said that the sell-through rate of Fitbit products for the Q3 period, based on their channel checks, was going to be down between 20 and 30%, they were right. Was this an unknown? Here's why I say they're sneaky. So Fitbit said their sell-through and sell-in is basically at equilibrium now, meaning what they're selling into the market is pretty much selling through in a timely fashion. Analyst estimates for sales for the Q3 period was to be down 22%. So basically, Cleveland Research just read the transcript and saw the analyst estimates and said, okay, yeah, 20 to 30%. If that's what the analyst estimates are, then I can put out a note that says sell-through is going to be down 20 to 30%, and it's perfectly fine. But for people that don't, regularly check analyst estimates or read transcripts at all, it may have concerned you, and you may have thought this is going to be worse than people expect. And the stock just kept falling and falling and falling until it actually dipped below $6 a share. But, there's nothing wrong with what Cleveland Research said. It was in line with analyst estimates and what management spoke about, but some investors just don't, they don't do the due diligence and look at what the numbers are for the quarter to be expected. So yeah.
And they see the note and they're shocked, and so they
jump ship.
Yeah, right. They sell or they tell their investment manager to sell or whatever. And okay, gotcha. Now, during the third quarter, Fitbit launched their first smartwatch ever. Yeah. This is huge. So how did that do? And what's your take on that product?
It's doing very well. Management spoke very highly of the sell-through rate, the product reviews. I tested it myself. It's really a very strong product. It has a really strong price point in the market. It's a lesser price point than some of the Apple Watches. It's on par with the Samsung Gears. But so far as total functionality and application, it's the best fitness smartwatch with some additional features. And some of those additional features will continue to roll out over the next, well, before Christmas. The app gallery will be, fully open to users of the Ionic. I checked out the reviews on Amazon, to see how they were performing. And it's important for people to understand how these reviews are generated. I wrote an article about that as well, because a lot of the reviews are false. They're posted by some fanboys or influencers. A lot of these companies, Fitbit included, they hire influencers to, write reviews about a product. They'll be able to test the product for themselves, so there's some semblance of, actual product usage. But Amazon also knows this because they can see the IP, from whoever's logged on. And if there's too many, reviews coming from the same IP, they'll wipe them out. They won't exist. I think Fitbit got up to over 500 reviews. The Ionic had over 500 reviews, and then the next day, all of a sudden, 350, because Amazon came in and they took out all the erroneous reviews. But even so, by and large, it has a 4.2 star rating, which is very high. And most people seem, pretty satisfied with the product. The sales, I would say they're doing what they're supposed to do. This was never going to be an iPhone where you have lines of people, waiting for the Fitbit Ionic launch to launch. It's doing well in the sales channel. Nobody's over inventoried, and Fitbit made sure of that. That's why the launch was just limited. Only certain retailers, received it. Target, Best Buy, REI, and it was only in select markets around the world. Also, Asia, some markets in the Asia Pac region, some places in Europe, and of course here in the United States. But in the fourth quarter, it should launch globally and to all the mass market retailers. Walmart just got theirs a couple of weeks ago, so not everybody participated in the launch. Fitbit wanted to make sure that the product quality, was on par, with their standard, or even above their standard, because this was a big deal for them. It helps them with price point. It doesn't help them with margin, I'll tell you that much. The smartwatches have a lesser gross profit margin than do their general fitness trackers. But at the same time, if you sell enough at a higher price point, you have a larger operating profit. And that's their goal. So it's doing well. I like the product. I'm probably going to get the Fitbit flyers, as a Christmas gift, so that I can, listen to music and whatnot. It's a little cumbersome to try to download music. You have to do it from your PC or your Mac, if you will. But other than that, driving in the car, it was counting my steps as well in traffic. And that still hasn't been fixed. I'm okay with that though. So, but other than that, the sensors and everything work really fantastically. Sleep monitoring looks really good. It's a really good ecosystem. What I'd like to see is them actually be able to generate subscriptions from their social network and their premium subscriptions to fitness apps. Right now, it's negligible, even though it grew 75% year over year. Their premium subscriptions, which are like $7.99 a month to get these, dedicated workout on your phone. I'm sorry, on your Fitbit Ionic, or you can pay $39.99 for the annual. So it grew. The subscription rate grew 75% year over year, but it's still less than 1% of their net sales. Recurring revenues for this particular business model would be a godsend. That's what made SodaStream stock come back. SodaStream went all the way down to $11 in 2015, I think. Today it's $66 because they sell CO2. They don't necessarily have to sell more soda machines. The CO2, when it runs out, the person has to go and get a refill. SodaStream gets their cut of that refill every time. So with Fitbit, if they can somehow generate, even more sales from premium subscriptions, that would be great. And they're also trying to do some of that with in the digital health space. They've signed some really, decent partnerships with Dexcom for glucose monitoring that may, unlock some of the recurring revenue potential in the future. But these are all in development, and they take time. They really take time. And remember, we're talking about less than 1% of sales right now are recurring revenues. That means if Fitbit did $393 million in sales this quarter, less than 1% of that. So even if they double that year over year, we're still talking about less than $10 million a quarter. So we're way off from ever seeing that be a incremental part of the business, but any little bit helps. So
absolutely. All right, so with all of that said, what do you think shareholders or potential shareholders of Fitbit can expect in the future?
A continuation of business improvement. Fitbit's done a lot of heavy lifting this year, cutting expenses, creating better products, streamlining operations. A lot of R&D spend has been booked into the numbers this year, and yet their balance sheet is really strong. They have no debt and $659 million in cash. You know what that means? Nothing. It really doesn't mean anything other than they don't have any debt. None of the, companies aren't going to be valued on their cash, especially with this business model. But it's still nice to have if you want to do other acquisitions and things like that. And remember, I said, what happens to these business models is at some point they have to wind up buying their distribution partners' rights for that region back. So they've got ample cash to do that. What I would expect is a continuation of improving metrics. Their guidance was pretty good. They tightened up, the guidance to the point where it really isn't going to take much to jump over a low bar, and the bar is still set pretty low. So new products will come out next year. All Fitbit really has to do is execute for this year. That's all they have to do is execute. The retailers are supporting them. Everybody else is dropping out. That's also what I wrote in that Under Armour piece is, in the coming years, there's only going to be 2 to 3 brands left standing in the wearable space. 2 to 3 of any significance. We're losing Under Armour. Garmin reported 2 consecutive quarters now of fitness tracker double-digit declines. So more than likely, they're going to push themselves out of general fitness tracker market in favor of smartwatches. But their position in the smartwatch market isn't very strong. Again, they just don't have the number of SKUs or the retail footprint that Fitbit does. So, and on the general tracker segment for Fitbit, a lot of folks are, the smartwatches are going to take over, and the general fitness trackers, they're going to be go by the wayside. But the reality is, every single quarter this year, Fitbit has seen sequential sales growth in their general Fitbit tracker line. So, it shows that they have really strong brand power. In the market, the retailers are behind them. They have a global presence. They're growing their ASP. I would continue to think in the fourth quarter the ASP should rise again, and then they'll have a more realistic comp to deal with in 2018. But insofar as the stock price will take care of itself in time, as long as Fitbit shows a trend. And if they execute and deliver on analyst estimates for the fourth quarter, I think the stock price will be rewarded because now you have a trend. They beat in the second quarter. They raised their revenue guidance a little bit in their second quarter as well. but that wasn't a trend. They beat here in the third quarter, but it was kind of marred by the fact that they lost their biggest distributor in their biggest market. 2/3 of their sales come from the United States. So, that's why the stock hasn't done anything. It's less than 20 cents down from when it reported beats on top and bottom line. So, it was a really weird quarter. And watching the after hours action on Fitbit stock, I was like, this is just like watching paint dry. You expect this big moves and nothing. It's because investors didn't know what to do with it. They're like, you beat, but you lost your biggest distributor. We need to hear more. And that's why it's actually outperformed GoPro. GoPro tanked on the same business model. They both sell hardware, gadgets, if you will. But GoPro took a pretty nasty hit, after they reported their results. And one of the reasons is they didn't meet analyst guidance for the next quarter. And I think in the past I had mentioned, GoPro's stock valuation, their market cap should not be bigger than Fitbit's. It doesn't make sense because Fitbit has a larger total addressable market than GoPro does. And that, of course, corrected itself. GoPro's market cap is now less than Fitbit. However, they are selling at a higher valuation to sales than Fitbit, which, so I'll go on record here, has to correct itself. So that's another reason why I believe, Fitbit's share price is still not reflecting the value of the company, the way it should. So I expect share price appreciation.
Yeah, I'm excited about Fitbit. We'll see what happens. We'll have to get back together again and reevaluate, review, and see what's what in coming quarters. So I'm also excited about phenomgroup.com. I know that you have this project in the works. You're working on it right now with your team. And this is going to benefit the investor and trader community in a big way when it comes to research, putting out the information, building a community, allowing and enabling traders and investors to communicate with each other. And benefit from your research. This entire video, we've seen how much research, the deep knowledge that you have on the retail space and on certain select stocks that you follow on a daily basis. Can you tell us more about phenomgroup.com?
Sure. So phenomgroup.com is going to launch in December. It's a financial news, articles, financial blogs. It'll have chat rooms. It'll have all your, stochastics for, individual tickers. It'll have institutional level research because that's what I've delivered, for the last 5 years. I've written white papers for hedge funds, banking institutions, portfolio managers, asset managers all around the U.S. and the world, actually, Korea, Sweden, Germany. But we're going to have that level of research at phenomgroup.com. It's going to be a place where investors can come interact with each other in the manner that they do on, let's say, StockTwits or Twitter, except we are going to have a moderator, to make sure that, we keep it on the level and we're sharing information. But, research, maybe you have some thoughts and that you'd like to put down, on paper and have it published. Phenomgroup.com is going to give you that opportunity to create your own profile where you can, you want to talk about Twitter. You have, an analysis you want to deliver on Twitter. That's fine. Submit it and our editors will check it over and publish it or give you feedback on it. If you want trade alerts, I'm a pretty popular trader and investor. New York Times did an article on me a few months back. They've done some other follow-ups with me. My returns have been pretty substantial over the years, and many of my followers know that. So our premium subscriptions are going to give you, advance notifications of all my trade ideas, trade alerts when they're happening, investment theses, and research. It's, we're aiming to deliver something to the investment community that, isn't there in a wide abundance. Phenomgroup.com launching sometime in December. We're aiming for the first couple weeks of December ahead of the high holidays.
Yeah, and I want people to bookmark phenomgroup.com right now. Keep checking back. You're expecting that launch in December. I know that the Golden Capital portfolio, your returns, your profits have been just really, really impressive. And it's because you do that research, okay? So
Right.
other people don't have to do this full-time like you do. Your research has benefited hedge funds and institutional investors all around the world. Hey, how'd you like to get, you watching this, how'd you like to get a part of that, okay?
Exactly.
The little guy, like me, the retail trader investor, should be able to get a piece of this action as well. So that's phenomgroup.com, Phenomgroup.com. It's in the description. It's also on your screen right now in the video. Seth, before I give away your email address so people can contact you and ask questions, did I miss anything?
What I would say regarding phenomgroup.com, we are, it's an exclusive launch. We're only gonna, we're gonna cap our premium subscription membership at 1,000, new subscribers. So if you want to be on that list, please reach out to me as soon as possible. David will leave the email. We're up to almost 700 so far. So. That's also why I wanted to discuss this in this video. Is the sooner the better.
Yeah, so people can reach Seth Golden if you want to inquire about becoming a premium subscriber of phenomgroup.com, or if you just have other questions or comments, you can, and it's right on your screen right now and in the description of the video. Seth.Golden at Coolinxit.com, Coolinxit.com. He's only accepting a limited number of subscribers, so if you want to get in, and it's getting fuller every day, so you don't want to miss out on that. That's phenomgroup.com. If you want to check out Seth on Twitter, his handle is @SethCL. On StockTwits.com, the well-known message board for traders and investors, he is @SethMarcus. All right, so I've learned so much. I'm trying to absorb it all. I might have to watch this video a couple times just to get all the information. But I'm feeling excited about Fitbit right now as a potential shareholder, and I'm excited about phenomgroup.com. So Seth Golden, we'll have to come back and review on a regular basis both this and all the other things that you've got on your mind. So
Absolutely.
Thank you so much, Seth Golden, once again for joining me on Looking at the Markets. Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.